Hello, everyone. Thank you all for joining. My name is John Pasalis, President at Realosophy Realty. Thank you again for joining on these monthly webinars I host. Talk about some of the latest trends I'm seeing in the housing market on the ground, and this month what to look forward to or what to expect in the fall market. So just a quick overview of what I'm going to be covering today. I'm going to be chatting about sort of the latest trends in the low-rise markets. That's houses, what's going on for condos, some on-the-ground trends we're seeing, maybe not in the quite MLS data yet, and what we expect for September. I'm going to chat a little bit about mortgage trigger rates, Bank of Canada, and potentially distress from sellers in the future. So some of the things I'm looking at. Couldn't fit that into this month's report, but we'll chat about it today. Talk about and show some stats on affordability for single family low rise homes with at least 3 bedrooms, so family homes, and how that's changed over the past 6 months, and then look at some of the municipalities with the biggest drop in prices since the peak in February. As always, I have Moose Marley, our editor, Ermi Desai, joining. So if you have questions, please feel free to post them in the chat, and we'll hit pause and go over them. Otherwise, I'm going to be moving at a pretty decent clip to not take up too much of your time as we go through here. So Ermi will be here. Feel free to post your questions in the chat, and I'll get the ball rolling by looking at the low-rise market. So when we look at number of sales for houses, July here in red, we're basically still at a pretty much a 20-year low. So you can kind of see sales are unbelievably low compared to even pre-COVID levels in 2019, and they are probably about a 20-year low. New listings are also well below 2019 volumes, and new listings are probably at about a 10-year low, and that's actually something that has brought a little bit of stability to the market. I mean, stability is not the right word because prices are still falling or have been, but it's interesting that sellers are not rushing to list, I should say, and I think it'll be interesting. We'll talk about some of the trends that might change in the fall market that might reverse that pattern. But right now, we're not seeing a ton of new listings and inventory levels. I mean, even though we're above last year, you can kind of see in red here, we're well below where we were in 2019. This past month, I think we're probably around 8,500 to 9,000 active listings for low-rise homes, compared to over 12,000, in 2019 pre-COVID. So there's not a ton of listings hitting the market, but the ones that are accumulating are largely because demand is tanking. So when we look at the months of inventory, which is how many months it would take for all the active listings to sell, we're approaching 3 months, and that has accelerated quite rapidly, and that's what's cooling the market. But again, that is largely driven by dwindling demand and the fact that sales are at 20-year lows, more so than a rush of sellers listing. When we look back to 2017 on this chart, and you see this spike in inventory, that was actually driven by a combination of both buyers pulling out and sellers rushing in. And we're not seeing as many sellers rushing quite yet, but inventory is still rising. The percentage of homes selling for over asking, of course, is plummeting now, just over 25%. So there are still sold homes getting bidding wars. I mean, but they're more balanced than we saw in the past. Like you have some agents listing for homes for 3, 4, 5, even 900,000 less than what they're worth. I mean, those homes are obviously going to sell for over asking, but aren't selling for ridiculous prices from my experience. And when we look at average price for low-rise homes, we are basically down slightly from over last year. We can kind of see prices have declined from just under 1.7 million to now just under 1.3 million. So we're basically down, a little bit over last year. And now if we move towards the condo market, similar kind of trends. We're seeing very, very soft sales. Again, 20-year low in sales for condominiums. New listings are at 2019 levels and well below the past couple of years. And active listings, and this is the one thing difference with the condo market, active listings are a little bit higher even compared to pre-COVID levels. We can kind of see here. And this has pushed the inventory levels, the months of inventory, higher for condominiums than for houses, or about 3.5 months multiple offers or prices selling above the owner's at list price is also declining. And prices are down. Now, they're not quite down as much as they are for low rise. And I think partly because a lot of the sellers who own condominiums are investors, and they weren't as distressed over the past few months as some low rise homeowners who have already bought expensive homes and needed to sell in order to close on their transactions. But I suspect we'll probably continue to see a little bit of downward pressure on condo prices because inventory is accelerating. And that's a little bit about sort of the latest trends. I'll kind of chat a little about what we're seeing kind of on the ground as we move into the fall market. Fall market, usually we tend to see demand pick up around July and August. People who want to re-enter the market in the fall, usually people hit pause. Even active buyers hit pause July and August because of the summer. We didn't know what it was going to be like this year just because of just the economic environment and if we were going to see this return of buyers entering the market. But, in our own office, we're actually seeing that. We see kind of some of these early trends on the ground. I mean, if the phone wasn't ringing and people weren't looking at buying, things would be a lot quieter, but we're definitely getting a lot of calls from buyers who want to enter the market in the fall again. And it's a combination of two types of buyers we're finding. People who hit pause in February, March, who just thought the market was insane and just decided to rent, and all of a sudden are feeling better because prices are down, $300,000-$400,000 in some of the areas that they were looking at. And just new buyers entering the market just because of personal moves and life changes who are looking at buying. So we're seeing a decent amount of demand. And I think sales right now are quite slow, partly because a lot of the inventory has been on the market for a long time. We're not seeing a ton of new inventory, some overpriced listings, but I suspect as we move into the fall, we should see strong demand. And my instinct is the growth in buyers will probably outpace the growth in new listings, at least over the first couple of months. And we'll see if that brings some stability to prices rather than sort of the downward trend we've been seeing. I'm going to move on to chat a little bit about this important question of sort of the Bank of Canada is going to raise rates probably again in September. And some of you may have heard of this term, a trigger rate, and are curious, what this is and how this is going to impact both certain households and maybe even if it doesn't impact you, how it might impact the market and the economy. So a lot of people who have, and there's kind of a couple issues right now. First is people who have taken out variable rate mortgages. In Canada, most of the banks who put people on variable rate mortgages are basically on fixed payments, which means that even when the prime rate increases, that borrower's mortgage payment actually stays fixed. And what happens is as the interest rate increases, more and more of their payment goes towards interest, less and less goes towards principal, right? So if we look back a year ago, the variable rate on the rate on a variable rate mortgage was under 1.5%, literally like this time last year. And if we fast forwards to today, of course, it's a full 3 percentage points higher. We're in the low 4% range. So what has happened is anyone who got a variable rate mortgage around that time, their payments have been constant, and they're approaching this period now where virtually none of their mortgage payment is going towards principal, and it's almost all going towards interest. And what happens is when the prime rate increases too much, and now they're not only not covering their principal, but their payment isn't enough to cover the interest, the banks are going to they're going to hit a trigger rate where the borrower is basically going to have to increase their payments. Now, every bank and every lender has different policies around this. The mortgage brokers that I follow, a lot of them think that if the Bank of Canada increases their prime rate by 50 basis points, so 0.5%, we'll see a decent number of variable rate borrowers hit by this trigger rate, meaning their payments are going to have to increase suddenly. If they increase the Bank of Canada rate by 0.75%, a lot of people think we're going to see a lot of variable rate borrowers impacted. So this is going to impact homeowners who have homes and just, all of a sudden are going to see their mortgage payment increase, who knows what, 20, 30% overnight. People who have investment properties are probably going to feel this impact. And this is what could, leads to a change in the market as we move later towards the fall. If you think about a lot of households who have multiple investment properties, all on variable rate mortgages, all of a sudden, if their rates are going up and their payments are going up significantly, they're going to be hit quite a bit. So this is the one thing we're going to be looking at as we move into September. Again, I don't think that's going to impact the market in September, October, but we might start to see that impacting the listing side and the selling side later this year, and that might lead to more inventory. The other thing that might lead to potentially more inventory is really people who have taken out private or short-term mortgages over the past year or 2 years during COVID. So private and private mortgages are, smaller lenders, people probably who just don't have the best credit and are paying higher rates. Those are usually on 1 or 2 year terms. B lenders are also on 1 or 2 year term mortgages. And if we think about the people who have those types of mortgages who are renewing now, they're running into probably quite a few problems, because when they're renewing their mortgage, in most cases, if they have a low-rise home, the value of their home has declined anywhere from 20 to 30%. So they actually have less equity. When banks and lenders think about their loan-to-value ratio, it has declined. So even if they went in with a 30% down payment or 35% down payment to start, well, when the values drop, now they're effectively their equity in the home is only about 20% or 15%. So they're going to have a hard time potentially taking on more debt if they need to, and they're going to have a hard time when it comes to renewing, because their mortgage payment is going to go up significantly. They probably got rates a year or two ago in the 2% range, and now they're going to be in the 4 to 5% range. And it's these households, and some of them are just regular home buyers who went to secondary lenders just to get into the market. And in many cases, investors who bought investment properties with a lot of leverage, they're going to start feeling it. And I think the combination of the variable rate owners and the people who have taken out private and short-term mortgages, I think many of them, quite frankly, don't even know what's coming. Like, they don't know the impact of these trigger rates, and they don't realize what's going to happen on renewal when they go to renew these mortgages, and in many cases are not going to qualify, might have to find themselves selling in a softer market. So I think these are probably some of the key things that we're going to be looking at. Again, I don't think we're going to see much of this in September, October, November. I think it takes time for these households that might be impacted by this to adjust to the market and decide to sell. So we might see that later this year and early next year. And again, we don't need tens of thousands or hundreds of thousands of households to needs to exit the market. 1 or 2 or 3,000 households who needs to sell because of these changing dynamics is quite enough to sort of shift the balance of the market quite a bit, especially in an environment where demand is as soft it is. So I hope that kind of answers a few questions. Urmi, I don't know if we have any questions or I should keep going.
Yes, we do have one related to that issue of potentially supply hitting the market from Vishwanath. With rents rising, will sellers hold back from selling more so in the condo segment? So I guess the idea here is that the rising rents may buffer some of this pressure.
That's actually a great question. And I think that's actually something I'm going to look at, maybe running some stats on in the next report. What we're seeing on the ground now is a lot of sellers who listed their properties who aren't selling or can't sell for a price they want are just taking them off the market and renting them, right? And again, they're renting them because rental demand is so strong. Rent is very strong. I think these investors are, optimistic about the housing market over the longer term and are just opting to rent them. And I do think that's one of the reasons why we're not seeing as much inventory, because the rental market is so strong. But again, I think we'll have to see what things are like when some of these investors are hit with these much higher mortgage payments. I mean, even quite frankly, if you got your mortgage, a fixed mortgage 5 years ago, you're probably in the 3% range, and today you're probably closer to the 5% range if you want another 5-year fixed. So even normal investors who have taken out 5-year mortgages are going to be hit by higher rates sooner rather than later. So, and I think that's where we don't know how the market's going to adjust. I think at some point you'll start to see some sellers exiting the market who are just too leveraged, but I don't anticipate a wave of this, but I do think we're going to start to see that probably later this year. And I didn't mention at the top, anyone who needs to leave early will be including, from the same link, you'll be able to watch a replay of the webinar if you need to step out early and catch the second half after the fact. I'm going to chat a little bit about what's going on with low rise, what I'm going to call family homes, which are basically what I'm calling 3-bedroom, single family homes. So row houses, semis, or detached, because I think this explains a lot about how insanely expensive the market was in the first quarter of the year, and why I think some buyers are re-entering. So if I look at all low-rise home sales and I say, okay, well, what percentage of those were 3-bedroom homes that sold for under $1 million? Under $1 million being an important price point, because at under $1 million you can buy with less than a 20% down payment. If you're over $1 million, you need 20% down, which of course is a lot harder for first-time buyers. So in the first quarter of this year, first 3 months, out of all the sales, only 7% of all homes in the entire GTA were 3-bedroom homes selling for under $1 million, right? And when we fast forward to the past 3 months, just over a quarter of all sales were 3-bedroom homes selling for under $1 million, right? So, if you are in this category and you wanted to buy a family home and obviously you were priced out in the first quarter, buyers have a ton more options. And when we look at, this is a chart that shows what areas saw the biggest increase. You can see areas like Richmond Hill, Stouffville, virtually no sales in the first quarter. Now we're seeing 20 sales. Mississauga, only 15 sales of 3-bedroom homes under $1 million. Now it's 150. And even the city of Toronto, 69 sales in the first quarter compared to over 400 now. And again, I think this is one of the reasons why we're seeing buyers re-enter the market. The buyers who we speak with who were active in the first quarter, I think many of them, quite frankly, expect that there's a good chance prices might dip further. Even if they buy this fall, they might fall a little bit further in the spring. But most of these buyers are buying for the long term, so they're not really as concerned about timing the market. They just want a home, and it's more possible today than it was, a few months ago, and they want to live there for 5 or 10 years. So I think this is what's motivating some people to step into the market potentially this fall. And again, we'll have to see what the market's like, and the balance between new listings and buyer demand will ultimately determine if we see a plateau in prices or if we see continued downward pressure. And we probably won't know that for the first maybe 4 to 6 weeks or so. I don't know if there are any questions about that. Otherwise, I'm going to kind of jump out onto the statistics for municipalities across the GTA. So I wanted to look at which cities in the GTA saw the biggest drop in prices. I focused on low-rise homes again, not because, there's, condos aren't as important, but condos haven't been hit as hard. Condo prices have not declined as much. It's the low-rise home market that has seen the biggest decline in prices. So I thought that would be an interesting segment to look at. And before we look at the biggest decline, I thought it'd be interesting to look at this. And these are all the cities in the GTA. So Halton, York, Peel, Durham, and the city of Toronto. And you can kind of see that the fastest appreciating municipalities saw prices almost double in 2 years. So Feb 2020 is sort of the last full month pre-COVID. The peak of the market was Feb 2022. And that's what those middle two columns show, the median prices in those 2 months. And you can kind of see for most of these neighborhoods, prices practically doubled or almost doubled in 2 years, which is just remarkable. And the worst performer, interestingly enough, at the very bottom of this list is the city of Toronto, where prices went up only 30% over those 2 years. I say only, that's still a lot, but compared to all the other ones, it's nothing. And then when we look at the biggest decline in prices, we can kind of see here, the worst performers, prices are down over over 30%, and they're seeing a big drop in price. I mean, Stouffville median price have gone from just over 1.5 million to 1.1. Municipal, like it's just even Oshawa, median prices were 1.1 million in February, and now they're 762. So a big drop in prices for low-rise homes in a lot of these municipalities, and potentially more to come, quite frankly, if the market stays soft in the fall. Now, I also wanted to look at, how have prices changed from pre-COVID, which is, Feb 2020, to the peak of the market, Feb 2022, and then to this current month. So what does July's, this most recent month sales, look like in comparison to the peak, but also to our pre-COVID levels? And the one interesting thing is that the city of Toronto is actually the only municipality in the entire GTA where house prices are roughly back to their pre-COVID price level. And we can kind of see here, Feb 2020, median price are 1.2 million. They, of course, increased up in February 2022, about 30%. And now they're just over their pre-COVID level. And it's the only municipality. And the reason that is even though Toronto prices haven't fallen as much as other areas, I think it's down 21%, it's because they also didn't appreciate as much during sort of this COVID boom. So, that 20% decline basically brought prices back to their pre-COVID levels. Now, when I look at the other municipalities, I'm not going to go through them in too much detail, but we can kind of see in all of these, Burlington, Halton, Milton, and Oakville, prices in July are still well above where they were at the beginning of COVID. Similar trends in Mississauga, in Caledon, and in Brampton. When we look at York, again, still prices are quite a bit higher than they were in pre-COVID levels. Even though they've dropped significantly, they're still quite a bit higher. And then this last one is Durham, which is one of the regions that saw the biggest boom in prices, partly because it was one of the most affordable regions. But again, prices are still well ahead of Feb 2020's prices pre-COVID. So that's everything I wanted to go over today. I don't know if we have any.
Yes, we have lots.
We have lots of questions.
Yeah, lots of great questions.
I will mention, for anyone who has any specific questions, obviously we're kind of keeping things pretty broad right here, but if anyone wanted to kind of go over some of their personal questions in more detail, I just published a link where people can sign up for a consultation on our website, Move Smartly, if you wanted to go over some of the trends in more detail or some of the specific questions that you have about your plans. But Ermi, I'll pass it over to you to go over any questions we have.
Sure. I'm going to go to the specific ones on some of the issues you've touched on, and then move out to some of the general ones. So a question from Alex. On the issue of distressed sellers, is there any data to quantify how many of those potentially distressed sellers might hit the market? So what is exposure like here in Canada?
That's a great question. So it's very hard to quantify because, again, there's no great data for private mortgages in Canada. And we do know, we have some statistics about, the share of households with mortgages, which is a lot lower than people might think. I think it's only about half of households who own their home have a mortgage. So the other half probably don't have a mortgage, but relatively few who have variable rate mortgages. Like before COVID, most people were going with fixed rate mortgages, but it's only in the past couple of years. And again, this is partly a dynamic of the stress test here, that people were opting for variable rate mortgages because it allowed them to qualify for more. And there's a bigger spread between variable rate mortgages. So it's hard to say. And again, the challenge is, just because someone's on a variable rate mortgages and they hit this trigger rate and they see their payment increase, it doesn't mean they're a distressed seller. Like in theory, they've been stress tested at a rate of 5.25%. So if you're just a household and your payment goes up, like in theory, you should be able to afford that. It might impact your finances in the short term. But it's the people, I think, who have multiple properties or investment properties are going to be impacted. And it's hard to say how many of those there are and the extent of that. But it has, I will say that from the mortgage brokers I speak with, because they see this a little bit more firsthand, that definitely there were probably more people who were investing, who were taking on private mortgages over the past couple of years just to capitalize on the market. So, we could see a decent number, but again, I don't think it's going to be a wave of defaults. I think it's just going to be, we'll see. I mean, it's really hard to speculate.
Great. And I'm just frantically typing here. A tech glitch means that I'm not seeing some of the questions that were asked. So if you do have a question that you asked that wasn't answered, just please re-ask it. I can remember some of the other ones.
I can see some of them, yeah.
Okay, great. There was also a question, John, around this idea of spillover. Like, do you think the softness in some segments will spill over to other segments, or how do you see that going?
The softness in the low-rise market?
Yeah, exactly. Spilling over to the condo sector. And what are you thinking in terms of that kind of, I guess, contagion?
Yeah, no, I mean, I think we're definitely starting to see the condo market slow down a little bit more. Inventory's building up far more rapidly. So there's probably going to be pressure on prices. But, like I said earlier with the one question, like the one positive thing for even some of these investors is certainly the fact that rents have been surging. And I do think that the boom in rents and the demand for condominium rentals is going to slow down in September. Certainly part of this is students returning to school and probably the first full year back in class this September. And that's, of course, going to take some demand out of the market after September, as many students are finding their accommodations right now. But high rents are going to help that. But it's hard to say what the pressure is going to be like. I think we're going to start to see pressures, quite frankly, on pre-construction and people who bought those who maybe are borrowing from their HELOC and have high payments and are a little bit pressured. But I don't know to the extent that, again, the strong rental market is definitely going to help the resale condo market.
And a question from Vishwanath, do you have any idea, maybe based on historical data or otherwise, when interest rates start to drop once they have peaked in general?
Sorry, what was the question again? When interest rates?
Yeah, so historically, do we have any sense of when interest rates hit a high, at the peak, and they stop rising?
How long does it take rates to come back down?
Yes, to come back down.
This is a tough question, and I think I had a video on our YouTube channel about this, about sort of these economic conditions we're seeing right now. And one of the challenges is it's going to be entirely a function of where inflation is going. And again, I mean, I don't know if you heard, the Bank of Canada got a lot of criticism because they went out, I think yesterday or the day before, and told employers not to give their employees much bigger raises because they don't want employers to factor in this high inflation environment into wages, because that will further increase inflation and become like a self-fulfilling prophecy. So again, a part of this is going to depend on where inflation is and how long it's with us. Again, if high inflation is going to, if it takes like 2 years for inflation to go back to 3%, then we're going to have high-ish rates for 2 years, right? So, and I think this is the challenge where you might just start to see some distress of highly leveraged households if rates take a while to come back down.
Great. We have a question here from Catherine, which is very interesting. We're thinking about moving within the GTA in about a year or two. We own our current home in the GTA. Is there any benefit in selling sooner rather than later and then rent until we find another house? Thankfully, we're mortgage free. Well, congratulations on that, at least.
Oh my, yeah. So, I mean, this is a great question. I mean, so generally in this market, buyers, I mean, homeowners who want to move should be selling first, right? So I would say you definitely want to sell first. Once that's, once you have your sale, then you can start looking at, another property. Now, with respect to the question of waiting, again, this is highly personal. I mean, certainly for clients who are worried about prices falling further, I mean, certainly you can wait on the sidelines. I always think it's better to when I say be active in the market, meaning look at a few homes, look at prices, because when the market stabilizes, usually we see that on the ground first, and we'll start to see it in the fall. Like a stable market looks like, homes that get listed start selling far more quickly. It doesn't mean crazy prices, but they don't sit on the market for 2 or 3 months like they are in some cases now. So, and again, if prices stabilize this fall, it doesn't mean that's going to continue into the new year. And that's the challenging thing with deciding when to buy. Like, you don't know when that low point is. So at some point, whatever buyer's buying is just going to have to take some leap of faith. And the challenging decision is that one. It's deciding when you're going to buy. And again, from my perspective, if I was buying, I kind of would think the same way most of our clients are thinking, that they're not going to time it perfectly. Like, even if they buy this fall, there's a chance prices might dip another, I don't know, however many % in the spring. And if that happens, it is what it is. If you're buying for the long term, you're buying for the long term. And, again, the challenge as well is you can't time when the right home comes on the market. You know what I mean? And so I think it's better to be active. If you find the right home and you can get it for a decent price, then jump in when you're ready. But trying to time it's going to be very hard. I hope that answers the question.
John, do you see any more specific questions in your view there?
Yeah.
Otherwise, I have a few more general questions. Yeah.
So, I have a few questions I've seen here. One question from Ian is, will the softness seen in the low-rise family homes? Okay, cascade into the condo. We asked that one. Low-rise was asked, what do I mean by low-rise? I mean townhomes, semi-detached homes, and detached homes. I also had another question from Alex who said, so because prices in Toronto are basically where they were pre-COVID, does that mean Toronto might have reached the bottom and the other municipalities have more room to go down? That's actually a great question. It's a good question. And again, I think, I don't know if Toronto's reached the bottom. Like, it's hard to say when we've reached the bottom. My instinct is if prices continue to decline, I suspect Toronto will not be leading over the next little while. Like, I think Toronto will have less room to go down compared to some of these suburban markets that saw a much bigger boom. But it's hard to say if prices are going to continue to, dip. And I think this is the one thing, even because I think as an investor as well, and I think one thing that investors have to think about is, like, even if you're looking at buying at pre-COVID prices were still expensive pre-COVID. It's not like Toronto home prices were a bargain in Feb 2020. So as an investment property, again, we got to think about what the numbers look like, because it was very hard to make the numbers work on investment properties even back then. So, it takes a little bit of research, obviously, but I do think there might still be pressure on Toronto, but not as big as in the suburbs. Go ahead.
To that point, in your charts that you were sharing around the biggest price movers in the GTA, it seemed like the ones that had risen the most during the pandemic were falling the fastest.
Yes, exactly.
So in that sense, Toronto, which didn't see as large an increase during the pandemic in terms of prices, is probably falling a little bit less, but has already reached its pre-COVID levels. Does that make sense? Whereas others would have to, prices would have to drop a lot more before they did.
100%. That's exactly what's happening. Now, there's another question about the Strong Mayors Building Homes Act and the question about them boosting supply. Again, I've chatted about, without going into the details, there's a report published this week by economist Mike Moffat, who kind of confirmed that the province needs about 1.5 million new homes within the next 10 years to keep up with our housing shortage and new demand. The reality is it's not going to happen. No matter, even if provincial governments and municipalities do put in policies to encourage more supply, those are all good things to do, but that in and of itself does not create more supply. At the end of the day, there's also a very, very big labor shortage. We can't double housing completions overnight. It's very hard for provinces and cities to do that. So I'm not expecting a wave of housing and supply is going to, put downward pressure on prices. I think I saw a report from RBC that basically confirmed that. I mean, even though they're pessimistic or bearish about the housing market in the short term, most economists are actually very bullish after that, because Canada still has this problem where our population is growing far more rapidly than our ability to build homes, which is partly why rents are exploding right now, right? So I don't think that's going to have a huge impact on the housing market. Again, even if we can increase supply, it's not going to be at a level that our province needs.
And it seems like they've started a little bit too late. A lot of great discussion on that is on your Twitter thread around Dr. Moffat's report and other reactions to the province's attempts to boost supply. Do you want to just share your Twitter handle?
My Twitter handle? Mine's just John Pasalis.
Yeah, so at John Pasalis, you can see a little bit more around that discussion around what the likelihood is that we will increase supply in Ontario. I think we had also had a question previously, which I found interesting around investing. Is it better right now to invest in REITs? So these are funds that are related to real estate rather than real estate itself right now?
Completely different investments. I mean, again, I don't, a lot of people think about investing in real estate as a passive investment, but it's really not, you know what I mean? Like, so even if you have the capital to invest in real estate, it's an active investment. And from my experience, to make it work and make the numbers work, you have to do something and be creative to fix your units, to renovate them if you're buying something, if you want to convert it to a triplex. So it's a tougher investment. Again, it's personal preference. I don't think it's one or the other. I tend to prefer real estate personally, but not to say I wouldn't invest in some REITs, but I tend to prefer, because I don't know, I find it more interesting. I kind of like, I'm in the business. I like having those types of properties, and I like the challenges about making them work financially. So I think it's personal.
And for viewers, John, REITs normally invest in what kind of real estate?
Well, there's different ones. I mean, so real estate income trusts invest, there can be some that specialize in apartment buildings, so purpose-built rentals, some that focus on commercial buildings, and some that focus on industrial ones.
Great. I think, and a good question to close on, invite any last minute questions if anyone has a few. So this is a perennial question, but are there some neighborhoods in Toronto that I think the question here is hold their value more than others? So whenever you see a downturn, you start to think of what you might call blue chip neighborhoods.
Is it hold their value or just have seen more value? Showing more value?
I think it's showing more. There's a couple iterations of the question. So showing more value or maybe showing more value. And I interpreted that as also tend to hold more value.
I mean, there are quite a few neighborhoods. And I mean, interestingly enough, I started noticing this in July before the monthly statistics came out, that there were a lot of sales that just looked like they were well below last year's prices. Showing value is a very difficult question to answer because it's very relative. Do you know what I mean? Like, but I find it remarkable now that you can get a, 3-bedroom semi-detached home, in the Danforth area for under $1 million, right? And some might say that that's insane. That's too expensive to spend 900 something thousand. From my perspective, it's not that. I mean, obviously you probably need 2 incomes for that, but you're relatively close to downtown. You're on the subway line. It's not, to me, it's not an insane price for what you're getting. So I think there are a lot of pockets. It's tough to say. Again, it's very specific, but there are quite a few pockets to me that are looking more attractive. And you saw the statistics that I published for Toronto, way more homes selling for under $1 million. So if you take that and you compare that to condominiums, for example, and this is what we're seeing with a lot of clients, I mean, homes are actually a better value. Like if you're looking at buying like a 1,200 square foot condo, it's actually cheaper to buy a 1,200 square foot house right now, right? So those are some of the things that we're seeing in a lot of different pockets. But again, I think when we look about neighborhoods, it's hard to compare because it's very personal. I mean, the types of homes you're getting in Etobicoke or Scarborough are very different from urban markets. But I'd say that there are a lot of pockets that I think show some decent value in Toronto right now.
A follow-up question from Bonnie on that. Do you know why some areas are not declining as fast as others? So Burlington versus Ajax. From your perspective, does this mean if I was interested in buying now, I should be looking and buying in these areas which are not seeing as much of a decline?
No,
as a more attractive
not.
area to live in the long term.
Yeah, so I wouldn't read. So I wouldn't necessarily conclude that the areas that haven't declined as much are better and more stable and less likely to decline in the future. Because part of this is just can be a combination of just, different factors. I mean, just the number of buyers looking at each different region at a specific point in time, the number of sellers who have listed and were distressed in this short period. So again, I wouldn't personally read too much into these market dynamics. Like Richmond Hill has held up relatively well. I think maybe partly because, maybe there weren't as many distressed sellers there. It's hard to say why some pockets. I mean, the ones that we can kind of say, like Toronto did not decline quite as much, likely because it didn't appreciate as much. But beyond some of these factors, it's hard to say why Scugog declined, far more than some other municipalities. So I don't know if I would necessarily make my buying decisions based on those trends. And again, because they could be just short-term factors. We don't know, what's going to happen over the next 6 months. And some of those areas and the balances the order of those declines might shift over the next 3 months.
I wonder if buyers should also keep in mind whether some of these areas saw a boom because of a very specific pandemic effect, which was, trying to get out for more space and more real estate. And so we saw cottage country and even farther flung areas like Scugog see a bit of a bump. Is it worth keeping in mind or maybe asking questions around how these areas performed during the pandemic specifically?
Well, yeah, in some of those areas, I mean, if you look at Scugog, Brock, King, like those are all areas with generally will have homes with larger lots, which is what people were interested in sort of at peak COVID. You couldn't go anywhere. People wanted big backyards. They wanted 1 acre. And, the appetite for that has declined significantly over the past couple of years. So there are very, far fewer people who needs to live on 2 acres or who want to live on 2 acres. And as someone who grew up on 10 acres, I think some people who actually bought there are realizing it's a lot of work to maintain and a lot of grass to cut, and it's very quiet. So I think part of this could be a shifting in patterns as well, and behavioral trends. And that's why it's hard. I wouldn't invest too much time in some of those most recent trends that we've been seeing.
Another question from Bonnie. I noticed new developments were rapidly increasing their prices to match increasing home prices during the peak. Since then, have you noticed new developments, so new construction, lowering their prices to match the declining home prices? Are we seeing that?
So I haven't followed what new builders are doing as closely, but typically, historically, builders, at least in the GTA, tends to be very slow to adjust to the market. And usually they'll just not launch new projects or wait 2 years for their current inventory to sell at the prices they want before they slash their pricing. And this is what happened in 2017 when prices fell in the suburbs. The number of sales of low-rise brand new homes declined because builders weren't dropping their prices. They were expecting 2017 prices. So I suspect we might see some downward pressure on prices potentially, but I think builders are going to be slower to adjust than, homeowners were.
A rather intriguing question from Lucky. I haven't seen this. Maybe you're familiar. What do you think about the narrative thrown around that you buy the payment, not the price?
Oh,
is that the thing that?
Well, I mean,
maybe you can unpack that as well.
So I guess what's meant by that is, when people are buying a home, what they're most worried about, of course, is what their monthly mortgage payment is, right? More so than the actual price they're paying. And this is quite frankly why home prices exploded during COVID, because interest rates fell to 1.35%. I don't buy that argument, quite frankly. I mean, I don't like that narrative as much, because here's the problem with that. I mean, I would rather have a 5% mortgage and a $700,000 mortgage amount versus 1.3% and a $1.2 million debt. Like, I would rather have a higher interest payments today and a lower mortgage principal, because what's going to happen is everyone who bought and took on these really, really high mortgages, yes, they had low rates a year or two ago, but now rates change, unfortunately, right? And they are not static. And despite what Tiff Macklem, Bank of Canada's governor, told us, that rates will be low for a very long time, clearly not that long, right? And I don't think, and I think a lot of policymakers are expecting the stress test to save everything. Yes, it'll definitely help the market, because even if you got a 1.3% mortgage, you qualified at 5%. But the reality is most people's budget and spending wasn't built around a 4 or 5% mortgage, right? So yes, I guess there's some truth to that, but at the end of the day, I get, but I'm biased because I'm relatively risk averse and cautious. So I wouldn't get excited by 1% mortgage rates, because I know that they're short term. But as a home buyer, and even as an investor, I'm more comfortable buying with 5% rates, because I know they're less likely to go up tomorrow, right? So, if anything, rates might go down, which might improve my numbers. And I'd rather be in that position rather than the position a lot of households were in right now.
Interesting. And Lackey follows up saying, most realtors in my community are stone hard on it, I guess, on that position that you buy the payment, not the price, because they say no one ever pays off a mortgage completely these days. They earn equity and move.
That's not true. Like I said, if you look at statistically, I think the Stats Canada, Bank of Canada, someone published last week that so 2/3 of households own homes in Canada, the other third are renters. And of those, I think it was about 50% of them have no mortgage, right? And
I believe it's even a bit higher. Yeah.
I think, yeah. So, and many of them for sure are people who bought their homes 40 years ago or 30 years ago and have lived there for a long time. But again, I mean, this idea that you never pay down your mortgage isn't true necessarily. I mean, some people just always, if you want to always upsize or refinance to buy an investment property, you're never going to pay down your mortgage. But if you keep your home for 15, 20 years, then yeah, it's possible over time to pay it down.
Great. Thanks for a great discussion. I'm going to close with this last question. And after that, John, maybe you can share an email where people can ask us future questions. So from Zaid, there was a report that BlackRock is preparing a $50 billion vehicle to buy real estate during the downturn. Will this be focused in the US? How will this change things? So corporate raiders, are they going to start entering the real estate market in the US only, or come into Canada?
So I think it was Blackstone, actually. So they're a big US company that has been buying up low-rise homes in the United States. Part of the concern was, are they going to do that in Canada? It sounds like they are definitely making more investments in Canada. From what they said, they're going to be making investments, though, in commercial, industrial, and student housing. So they're not necessarily going to be buying single-family homes. But there are tons of investors and smaller REITs that are buying homes, which has certainly made it harder for homeowners and home buyers to compete. But I don't think we're going to see a big wave of that, especially not in the GTA, because prices are so high. A lot of these companies, even when they're active in the US, they're in very, very affordable markets. So I think it's going on in the GTA, but not nearly to the extent that it is in some other markets in the United States.
Great. Well, thanks, John. Everybody should be able to see the ability to book a consult for any specific questions they have about real estate. If they have any more general questions that we might want to raise in a future webinar, could you just share the email?
Yeah, they can email me at askjohn@movesmartly.com.
Great. And I thank everybody for joining us. We do these once a month as soon as our real estate report is released. Every month, you can find that and more at movesmartly.com. Thanks, everyone. Thanks,
Thank you.
John.